Hi, this is Dana Great from Camelot Advisors. Daniel Kahneman won a Nobel Prize in economics in part for teaching us that how you frame information affects how you feel about it. For example, what if I told you in the past year we had observed the S&P 500 with a 20% gain? What if I added to that within the past year we had also observed the S&P 500 with a 25% loss? Of course, framing also matters in terms of time horizons. So widening it out beyond a year to 2 years, in spite of the rises and falls, the S&P 500 has been flat, meaning that investors in stocks over that time frame have gotten a little bit less than a 0% return. But they did better than bond investors who lost 8%, which is unprecedented. So what are we to make of this? Well, a couple of things. One is our time horizons are much longer than even 2 years. And what the rise and fall tells us is that there's just a lot of volatility in the markets now. I think that there's more volatility ahead. And the reason for that is because the most important phenomenon we are witnessing right now is a rapid increase in interest rates. This is beyond the Fed, and it's the bond market. Two years ago, a 2% treasury rate was astronomically high. Now, 4% is normal, and many people see 5 and 6% on the horizon. Mortgage rates have gone from 3% to close to 8% in some situations now. So what does that mean? Well, the good news is for our fixed income portfolios, we can invest money and we can earn higher interest rates. In fact, we can get close to our target allocations, at least in the short run, just investing in fixed income. That said, we don't want to only invest in fixed income. We want to stay diversified because, as we can see from the past couple of years, fixed income sometimes can deliver us somewhat unpleasant outcomes if rates go even higher than we could imagine, to maybe 10 or 15%, which has occurred within my lifetime. The other problem this creates is interest rates become a hurdle for stocks, meaning every dollar of prospective earnings a stock earns is worth less if interest rates are higher. The only outlet for that, or the only adjustment, is that the price of the stock must fall. And I think that's why we're seeing some drama in the investment markets now, a correction or a repricing of risk assets. This extends beyond stocks and even into housing and other non-traded assets. That said, we remain vigilant, we remain committed to our discipline and our focus on rebalancing and working as many of our magic tricks as we can to overcome the macroeconomic headwinds. That said, I hope that will give you peace of mind and enable you to go out and enjoy what is turning into a lovely fall. Thank you.